This morning, the CNN reported a significant news about the stock market, which has been on a steady rise. Americans are now holding more money in stocks than ever before, a trend that economists warn could pose serious risks. A potential market downturn, they caution, could hit Americans harder than at any point in history. According to CNN's Egan, the booming stock market is a double-edged sword. On one hand, the ongoing market rallies are a boon for the economy. Each record high in the market inspires confidence, encouraging people to spend more, whether it's going out to dinner, buying a car, or taking a vacation. But this increased exposure to stocks also leaves Americans vulnerable to potential market meltdowns, which have occurred in the past. The level of exposure is unprecedented. Stocks, both directly and indirectly held through 401(k)s and retirement plans, now make up 45% of household finances, nearly half. This is the highest on record, dating back to the 1950s. To put this into perspective, back in 1980, stocks accounted for just 13% of household portfolios. Today, that figure has skyrocketed to 45%. However, this exposure isn't evenly distributed. The top 10% of households own a staggering 87% of the stocks. Despite this, higher-income households are the ones largely keeping the economy afloat. A market reversal or downturn could lead these households to cut back on spending, which could have ripple effects across the economy. The significance of recent events cannot be ignored. In March and April, fears of a market meltdown were sparked by concerns over the president's proposed tariffs. Fortunately, the president paused those tariffs, averting a potential crisis. Since April 8th, the S&P 500 has surged, gaining a staggering $15 trillion in value. The key takeaway is that while the stock market isn't the real economy, its influence is undeniable. With record-high exposure to stocks, the market's movements, whether up or down, have a significant impact on economic behavior, for better or worse.